While the world watches American tomahawks and Israeli missiles turn Iran's sky into a literal war zone, the smart money isn't looking at the fire. They're looking at the fallout in your wallet. Everyone's screaming World War III, but here's the real kicker. Why is your silver tanking while the world is burning? You're watching an 8% faceplant that's gutting portfolios in hours, but don't be fooled. The missiles didn't break this market, the margin calls did. This isn't a sell-off, it's a high-stakes liquidation trap, and the mainstream media is too chicken to tell you the truth. If you want to stay ahead of the explosion, smash that subscribe button and hit like right now. Also, drop a comment below and let me know exactly where you're watching this from. I want to see how far this message is reaching. Now let's get into why the paper price is a total lie. The silver market didn't just dip today, it got jumped in a dark alley. We're looking at a brutal 8% faceplant in a single session, and if you're scrolling through the mainstream headlines, you're being fed a fairy tale. They'll tell you the story changed. They'll tell you the supply deficit vanished while you were sleeping. Absolute garbage. Silver didn't tank because solar farms stopped needing it, or because defense contractors went low-tech. It cratered because a massive over-leveraged whale just got their throat stepped on by a margin call. When a broker smells blood, they don't give a damn about your long-term thesis. They want cold, hard cash, and they'll burn your house down to get it. As of Tuesday, March 4th, 2026, the carnage is everywhere. Silver is screaming at $81.91, gold is bleeding out at $5,076, and platinum just got taken behind the woodshed for a 10% loss. Every single one of these numbers is screaming the same secret, a secret the experts are too scared to tell you. But here is where the glitch in the matrix gets real. While the metals are burning, oil is exploding over 8% because the Strait of Hormuz is turning into a literal war zone. Usually, when bombs start falling, gold and silver are the ultimate bunkers. So why the hell did they just sell off? Because the old playbook is dead and buried. Look at the 10-year Treasury yield. It didn't fall. It spiked to 4.11%. That is not supposed to happen. It means the market isn't just scared of the war. It's terrified of the war-driven inflation that's about to melt the dollar. We are watching a mechanical liquidation where the big players are forced to sell their gold jewelry just to keep their main house from foreclosing. This isn't a change in value, it's a desperate scramble for dollar liquidity. If you want the absolute smoking gun that this move is a total fake-out, look at the gold-to-silver ratio. It just blew out from 57 to over 62 in a heartbeat. That is the biological fingerprint of a forced unwind. Conviction selling is slow and methodical. Margin selling is violent, messy, and loud. Platinum dropping 10% confirms the crime. This is a broad-scale hit on industrial metals by algorithms that don't know the difference between a silver bar and a tech stock. Meanwhile, back in the real world, the physical supply deficit is actually getting tighter. The Strait of Hormuz isn't just an oil pipe, it's a choke point for the global economy. If you think a paper sell-off on Wall Street changes the fact that China is starving for silver to build its solar empire, you're dreaming. Here is the secret the suits on CNBC won't mention. While the paper price on your screen went down 8%, the premiums to actually hold a physical coin in your hand just went up. The spot price you see right now is a total hallucination. Real-world buyers, the guys who actually use this metal for semiconductors and satellites, are stepping in right now and scooping up every ounce they can find. They know that paper dislocations always, eventually, snap back to physical reality. The question isn't whether silver is broken, it's whether you have the stomach to realize that today is the greatest setup we've seen in months. The physical market is screaming that this price is wrong. Let's talk about the Fed, because they are stuck in a room with no exits. Before a single strike hit Iran, the ISM prices paid index was already at 70.5. That's a factory-level inflation explosion. Now add an oil shock on top of that. The cost to build everything, from solar panels to chips, is about to go through the roof. Most people think higher costs kill demand, but in a silver-intensive world, it's the opposite. When energy prices surge, the efficiency that silver provides becomes the most valuable asset on the planet. Higher manufacturing costs don't destroy the silver thesis, they make it the only survival strategy left for the global tech industry. What should actually keep you awake at night isn't the 8% drop, it's the velocity. Silver rocketed from $72 to $96, and it just gave back 8% of that in a single session. This kind of volatility is the signature of a market under extreme systemic stress. We are in a regime where paper leverage has grown so bloated compared to the actual physical metal that the system is starting to fracture. These moves don't resolve quietly with a whimper, they resolve with a bang. We are approaching a moment where the paper market and the physical market are going to have a violent divorce. I'm watching two specific price levels that will tell us if the bottom is in or if the bloodbath has just started. Scenario A is the V-shaped recovery. If silver can stabilize above $78 and reclaim $85 in the next 72 hours, the shorts are cooked. $78 is the base of the mountain. If that holds, it means the real buyers have successfully absorbed the margin calls. But scenario B is the deleveraging nightmare. If we break $78 with heavy volume, there are more margin calls in the pipe. And we're looking at a trip back to $72. I don't care about being right. I care about the data. And the data says the next 3 days will define the silver market for the rest of 2026. The ultimate confirmation for this whole mess lies with gold. If gold can't defend the $4,900 floor, we aren't just looking at a silver sell-off, we are looking at a total regime change. That would mean the Fed is planning to tighten rates into a war, effectively choosing to crash the global economy to save the dollar. If that happens, the playbook changes entirely. But until that level breaks, everything we are seeing today is just noise. Mechanical, forced selling by people who were over their skis. The factories haven't stopped. The deficits haven't closed. The world is still running out of silver. The world is still running out of silver. But if you look at your screen, you'd think it was a garage sale. We're standing at a massive crossroads. If the Fed decides to play tough and hike rates into a global conflict, they aren't just fighting inflation, they're declaring war on every hard asset on the planet. But here's the kicker. Silver doesn't give a damn about a Fed meeting when the solar vaults in Shanghai are empty. We're witnessing a violent divorce between the guys who trade digital contracts and the guys who actually need the metal to keep the lights on. Think about it. While the paper hands are panic selling to cover their losses in tech stocks, the industrial giants are licking their chops. You think Elon or the big solar conglomerates are worried about a 10-year yield spike? Hell no. They're worried about where their next shipment is coming from while the Strait of Hormuz is clogged with warships. This isn't just a bad day for the market, it's a systematic transfer of wealth from the weak, leveraged gamblers to the heavy-hitting industrial players who know that you can't build a 2026-grade semiconductor out of thin air or paper promises. Look, the mainstream media is going to try to sell you a decline and fall narrative. They'll point to the $81.91 price tag like it's a death sentence. But they won't tell you that the warehouse inventories are draining at the fastest rate in history. They won't tell you that for every 1 ounce of physical silver available, there are hundreds of paper ounces being traded by computers that don't even know what silver looks like. Today's 8% crash is a gift for the grinders, the ones who understand that when the system breaks, the only thing that matters is what you can actually hold in your hand. You've got to ask yourself, is the silver in a Tomahawk missile suddenly less effective because some guy in a suit in Manhattan got a margin call? Of course not. The tech demand is inelastic. It's must-have, not nice to have. And when you combine a must-have resource with a can't-get supply chain, you get a powder keg that's just waiting for a match. The paper sell-off is the match, but the physical deficit is the dynamite. We are leaning into a scenario where the price on your phone screen becomes completely irrelevant because nobody will be willing to sell the real stuff at that fake price. This brings us to the ultimate showdown. If we see silver bounce off $78 like it's made of rubber, it's a signal that the floor is officially set. That $78 mark is the line of death for the shorts. If they can't push it under that, they are going to get squeezed in a way that makes 2021 look like a playground game. We're watching the smart money build a fortress at these levels while the retail crowd is being flushed out by fear. It's a classic shake the tree move, and boy, are the weak branches falling fast today. But wait. It gets even more twisted. If the dollar index keeps ripping toward 100, it's going to put a chokehold on every emerging market and every commodity. That's the liquidity black hole scenario. In that world, everything, gold, silver, oil, even your neighbor's dog, gets sold for dollars. But history shows us that these black holes are temporary. When the dust settles and the Fed realizes they can't actually let the whole world go bankrupt, they'll pivot. And when they do, the spring back in silver won't be a bounce, it'll be a sonic boom. You need to keep your eyes glued to the spread between the COMEX price and the London physical premiums. If that gap keeps widening, it's a direct middle finger to the paper market. It's the market saying, we don't believe your $81 price tag. We're seeing record deliveries being stood for, which means the big boys aren't taking cash settlements anymore. They want the bars. They want the metal. And in a world where the Strait of Hormuz is closed, wanting and getting are two very different things. This is exactly why the three triggers I'm about to lay out are so vital. You can't trade this market on vibes or hope. You need cold, hard metrics. We are currently in the eye of the storm. The initial shock is over, the margin calls are being processed, and now we wait to see who is still standing when the bell rings tomorrow. This is where the legends are made and the paper millionaires get wiped out. Don't let the volatility blind you to the fact that the silver story hasn't changed. It's just gotten a whole lot more expensive to ignore. The dust is settling, but the air is still thick with the smell of a rigged game. We've established that the 8191 print is a total paper hallucination, but even a lie has consequences if it lasts long enough.